Hello, everybody, and welcome to a special edition of our Smart Tax School webinar. My name is Amar Medic, and I am the Product Manager for TaxWise. In today's webinar, we'll be covering numerous changes for individual returns from one big, beautiful bill. Topics covered include changes to standard deduction, qualified tips and overtime deductions, car loan interest deduction, and clean vehicle and energy credit terminations. Keep in mind that we try to host one webinar per month, so please be sure to join us in the future as well if you find today's session to be informative. During the webinar, you'll be able to submit questions to the team and get those answered live. With all that said, I'm very pleased to introduce our main speaker for today, Michael Hannigan. He's a federal tax editorial manager here at Wolters Kluwer with years of experience working in the tax industry. He's the managing editor for all of the federal tax content in CCH Answer Connect and has been the managing editor for the U.S. Master Tax Guide since 2013. So with all that, let's get started. Michael, please take it away.
All right, thank you, sir. I appreciate it. I appreciate you all for being here today. I don't know if I did one of these a month ago. It was more business focused. I don't know how many of you on the webinar today are return visitors. Not going to be a lot of overlap between what we talked about last time and this time, but there might be a little bit. We're going to be focusing more on individual issues that came out of the One Big Beautiful Bill Act. Like a lot more widespread and more broadly applicable things for individuals in OBBBA than for businesses. So kind of a lot to cover here today, so I'm going to be going pretty fast. But hopefully you find it helpful. We're like Amar said, we're going to be talking deductions, all the new stuff. We're going to get into TCJA extensions, which is the bulk of the bill. I'll get into that a little bit more later. But let's go ahead and get started. We're going to start with the big new fancy provisions that were in the One Big Beautiful Bill Act. These are kind of like the headline things for individuals. Let me close my email so it stops doing that. Sorry, everyone. Forgot to close my email. Okay. So, so new provisions. The first one I'm going to talk about is the new senior deduction. Just to get something out of the way early, a lot of the talk in the run-up to the bill and even in like the month or so after the bill was that there's a provision for no tax on Social Security income. That is not in the bill. There's no provision in the bill for no tax on Social Security income. This is about as close as it gets for, a pretty good bulk of senior citizens who receive Social Security income. This deduction will take care of a lot of it. Will actually make that tax-free just because of the deduction. So the senior deduction is effective from 2025, so this year, through 2028. It is a $6,000 deduction for individuals age 65 and older before the end of the year. So, the same rules that apply to the additional standard deduction for elderly people. It's up to a $12,000 deduction for joint filers if they're both 65 or older. So, it's for each of them, right? It kind of functions like the personal exemption used to. Interestingly, like in the code, it's in the same section where the personal exemption was. It's kind of questionable whether they should have done that a lot or not. There's been a few things have popped up as we've been going through things like NOL carryovers and things like that. So we're not entirely sure it should be there, but that's where it is. It does phase out for higher incomes. So if you're maybe filing jointly, it's 150,000. Single, maybe filing separately, it's 75,000. It phases down 6%. So I don't feel like doing the math on that one, but I think it's, for a individual that looks like it would be up to like 175,000 of modified adjusted gross income is when that $6,000 deduction would completely phase out. Like a lot of the things in the One Big Beautiful Bill Act, it's gonna come up a lot in this hour. You need a Social Security number to claim it. So it's not a tax taxpayer identification number. It's a social security number, right? So, and we'll get into this a little bit more at the end of this section, but you don't need to itemize to claim it. So it's not, the word that used to get thrown around for that was an above the line deduction. It isn't an above the line deduction. It does come in on the tax form after adjusted gross, but regardless, you don't need to itemize your deductions to claim it. Like I said, this does follow the same rules as the additional standard deduction for the elderly, and it does not replace it. So, that additional standard deduction for the elderly, or the blind, right? It's the same thing. That is still there. So it's whatever that inflation adjusted amount is every year. I think this year it's like $1,600, but don't quote me on that. You could claim them both, right? But unlike that additional standard deduction, this $6,000 is flat. It does not increase every year for inflation. It is a flat $6,000 for the whole 4 years. So we're going to keep on going. Another big thing that was in the run-up to the bill and in the aftermath was no tax on tips. Technically, that is accurate, but it's a qualified tips deduction, right? So again, like the senior deduction, it is effective 2025 through 2028. It is a $25,000 deduction of tip income, of qualified tip income. We'll get into in a minute what that means. It is reduced $100 for every 1,000 in excess modified adjusted gross, over 150,000, 300,000 for married filing jointly. This is one of the rare provisions in the One Big Beautiful Bill Act that there has already been some guidance on. It's been pretty slow coming out since the bill passed, and now with the government shutdown, it's still, parts of it are still functioning. We're still getting some IRS guidance, but not a whole lot. This is one that we have gotten guidance on. There were proposed regulations released on September 22nd. Again, like the senior deduction, there is no need to itemize. Again, I'll explain that in a minute. But, and like the senior deduction, social security number is required, right? So again, not a taxpayer identification number is not good enough. It has to be a social security number. So we're going to keep on going on the qualified tips deduction. We're going to talk a little bit about what it means, right? So like I said, it's that $25,000 deduction is on qualified tips. So the legislation, the One Big Beautiful Bill Act does spell out partially what a qualified tip is. It's a cash tip received by an individual in occupation that customarily and regularly receive tips on or before December 31st, 2024. The guidance that the IRS released expands on that, and I'll be talking about that in a minute. The amount received is paid voluntarily without any consequence for non-payment. It is not the subject of negotiation. It is determined by the taxpayer, or by the payer of the tip, right? So it's a tip. It is what we customarily understand to be a tip. If it's the kind of tip, so if you go to a restaurant and it's they automatically add the gratuity for 6 or more, that does not qualify. That is there is a consequence for non-payment of that, and it's equivalent to not paying your bill. So it has to be a voluntary payment. It can't be an automatic gratuity added to something. The trade or business in which the individual receives the amount is not a specified service, trade, or business as defined in Code Sec 199A. That is the qualified business income deduction. So it uses kind of the same rules that you couldn't take a qubit deduction for. So that is things like health, law, architecture, accounting, I think. It's those kind of things. You can't tip your lawyer, and the lawyer can't take a deduction. So one thing that wasn't in the legislation, but that did come out in the proposed regulations is it's a qualified tip is not for the business owner. So, I mean, there's always been that kind of unwritten rule that not everybody follows. Some people follow it, where if you go to get a haircut or whatever, right? If the barber is the owner of the barber shop, you're not really qualified. You're not really required to tip in the tipping standards that maybe your grandmother taught you, but in this case, the owner is not allowed to take that deduction. So you can still tip them, but the business owner can't take the deduction. Another thing that came out of the proposed regulations is that you can't claim the deduction for a tip for illegal activities or other specified activities. I don't know what kind of illegal activities you're tipping in. I don't know if you tip your drug dealer or whatever, but would certainly not qualify. And, for other specified activities, the proposed regulations specifically list out prostitution and pornography. So, take that what you will. But keep on going. Tipped occupation. So the rules spell out, the requirement of what was a tipped occupation on December 31st, 2024. The proposed regulations have an extensive list of, what these tipped occupations are, and it's broken down into 8 occupational categories. So like beverage and food service, entertainment and events, things like that, right? And within each of these categories, then there are specified job titles listed out. So, bartender, waiter, maitre d', like that kind of thing, right? For each of those jobs, the proposed regs provide a Treasury tipped occupation code, a TTOC. I think it's a 4-digit number. From the guidance and the proposed regulations, it looks like they might be changing the W-2 to allow for that reporting for that Treasury tipped occupation code to be provided. And it sounds like from the guidance that is part of the required reporting for employers. We haven't seen a draft W-2 yet that I'm aware of that does list this out. The only W-2 out there is, still the one that was released at the end of 2024. So, we'll kind of keep an eye out for that. I will say that, and again, we're going to get into this in a minute, on the employee side of things, we're not entirely sure if that TTOC is going to matter or not for the employee, for how they will report and claim the qualified tips deduction, but we'll see. For those of you who are CCH Answer Connect subscribers or looking to be, we did launch a smart chart that takes that table and breaks it down into those 8 categories, and you could search for it. You could search for the job and get that TTOC. Again, I think that's going to be more relevant for employers than employees, but it's out there, right? So for any of you who have employers as clients, that might be something that you'll need to know about. All right, so we're going to keep on moving. The next thing the next big new thing that came out of OBBBA was the qualified overtime pay deduction. This is known as the no tax on overtime. Again, very similar in structure to the qualified tips deduction, just like the senior deduction and all the other new things from OBBBA. It is effective 2025 through 2028. It is a $12,500 deduction or $2,500 for joint filers. Similar phase out to the tips deduction. It's reduced $100 for every 1,000 of modified AGI over those threshold amounts. An important thing to remember is that it is limited to the overtime pay as defined by the Fair Labor Standards Act of 1938. So, the simple example is if you work if you work 50 hours for an employer, for those 10 hours over the 40, you'll get time and a half. It's the half that is deductible. It's not the time and a half, right? So, if you make $10 an hour and you get $15 in overtime, it's the $5 per hour that is deductible, not the whole 15. The bill text spells out that it applies to non-employees as well. which includes which is like an independent contractor. Again, this is one of those areas we haven't gotten guidance on yet. And so we're not really clear how that works because the Fair Labor Standards Act only applies to employees, not independent contractors. So we're not entirely sure how those two things really mesh. So hopefully we'll get some guidance soon because, it's October. So, people are going to have to start worrying about this towards the end of the year, especially from a reporting standpoint. So we're still waiting on that. Right after OBBBA passed, the IRS had some, lists of, we're going to have transitional guidance on, these provisions. This was among the things that they were going to have transitional guidance for by the end of 2025, but we haven't seen it yet. Again, no need to itemize to claim it. It's available for non-itemizers. And again, Social Security number is required. So the last big new thing that came out of OBBBA is the car loan interest deduction. Again, this is 2025 through 2028. It is a $10,000 deduction, and it is reduced $200 for every $1,000 of excess modified AGI over those threshold amounts, $100,000, $200,000 for married filing jointly. The loan must originate with the car after 2024. So it's, anytime during 2025. It's only for new vehicles. It's only for personal vehicles. So it's not fleet vehicles. And it has to be secured by a first lien on that vehicle. Again, no need to itemize. There is no requirement that a Social Security number is required for this one. So, it's available to anybody, whether they have a TIN or an SSN. The legislation spells out some pretty significant reporting requirements that, it's basically going to require a new information return that looks like maybe a 1098 or something. And it's going to have to list out the, the make of the car, the model of the car, like everything relevant about the car itself, the original price of the car, the amount of interest, like obviously. But the IRS literally like 2 days ago released some transitional guidance on this. I believe this is the only other piece of transitional guidance we've gotten on OBBBA provisions since it passed. That for this year at least, a lot of those reporting requirements are going to be kind of muted. There's not going to be a specific form. I think part of the reason for that is that, that with the shutdown and everything, the IRS just isn't going to have time to create that form. So lenders and, sellers of the vehicle can get that information to taxpayers through other means. Oh yes, I did. I saw a comment in the chat there. Totally apologize. It does have to be I do believe it does have to be a manufactured in the U.S. vehicle. Sorry about that. Thanks for catching that. So yeah, so these reporting requirements, sellers are going to be able to provide that in an online portal basically. So I think that's probably how most people pay their car payments these days is through some kind of portal. So they're just going to be able to report it in that way without an official 1098. And it's not going to be all the requirements, basically just going to be, interest and stuff like that. I don't believe, I saw another question, I don't believe it applies to refinances. I think it's only on the sale of a new vehicle. I don't think it's for refinances. I could dig in on that a little bit and see if that's true or not. So I've been talking a lot about the reporting part of this, right? So we don't have any official forms yet. We don't have a draft 1040. What we do have is a draft Schedule 1A, which is where the IRS put all of these eggs. All of the new things are all on this one schedule. They have the same effective dates. They have similar modified adjusted gross income requirements. From what we can discern from this draft instruction, it's going to be treated very similarly to the way that the qualified business income deduction is treated, which, like I had said earlier, is a below the line adjustment to taxable income. I think think it's on line 13 of the 1040. If you get, and I don't have it pictured here, but on the second page of the Schedule 1A, it says something about like, enter it all on line 13B. So 13 is where the qualified business income deduction currently is. So I'm assuming that's going to be 13A, right? So, like I said, IRS put everything into one place on this thing, which really does make sense because, if these things do expire, it's just easy to just, plug this form out. You don't have to, it's not going to be relevant anymore after it expires. So, and then, it's just an easier change to the 1040, right? So to just make that 13B and back into 13 and just, move on. Will these things ever actually expire? I don't know. I'm going to guess they're going to be extremely popular. And it's pretty hard to get rid of a pretty popular deduction after a few years. So, longer term, we might see a change in the way this is reported. But generally speaking, it is, it's just going to be the Schedule 1A. Like I said, we haven't seen a draft 10 or a draft W-2 yet, so we don't know what the other end of this reporting requirement's going to be. But yeah, so it's interesting. It's it's a pretty straightforward form. So and just everything's going to be all in one place. So yeah. Just to address a question, there was a question: will TIPS qualify for the deduction for legalized prostitution? I don't think it does. If I remember right, it specifically lists out prostitution, and it doesn't specify whether it's legal or illegal. So yeah, so it's a good question, right? And like certainly if you're in a state that has legalized prostitution, it's a relevant question. So I think that's what it says, but so yeah. Oh, hey, the draft 1040 is out. Oh, I didn't even see that, so thanks. Okay, so we're going to go to our first polling question. You could answer the question, true or false, the $6,000 temporary senior deduction replaces the additional standard deduction for the elderly. So go ahead and take your time with that. We'll give you a minute to answer. You guys are answering fast. Thanks. I appreciate it. Give about 20 more seconds. Ten more seconds. 3, 2, 1. Okay. Move on. The answer to the question is false. It does not replace the additional standard deduction. It is in addition to it. So I'll stop saying the word addition. But yeah, very good. Those of you who got that right. It wasn't on the screen. I had only said it. So great job. All right. So we're going to keep on moving. Just as a little bit of background on both the One Big Beautiful Bill Act and going back to 2017 with the TCJA. Most of the individual provisions of the Tax Cuts and Jobs Act had a built-in 2025 sunset date. Theoretically, they did this for budget reasons. I think it was probably for political reasons as well, to make it into an issue in the 2024 election, which it certainly was. Most of the things were scheduled to sunset at the end of 2025. Which was really one of the most important reasons for the One Big Beautiful Bill Act to get passed, right? They had to address these things. There were going to be massive changes, and it would resulted in pretty significant tax increases for a lot of people. So they had to address it. And what they ultimately did was they made a lot of it permanent. I was shocked by this. If I was betting on it a year ago, I would have said it would have been another 4 or 5 year extension. But most of the stuff that was scheduled to sunset was made permanent. So let's kind of get into this. And of course, I say most of the things were permanent, and I'm immediately going to undercut myself with that because one of the big political issues in the run-up to the bill was the SALT deduction, right? The state and local tax deduction. For those of you who remember, and probably were dealing with it the last few years, TCJA put a cap on the SALT deduction of $10,000. It was a flat cap. It didn't adjust for inflation. It didn't do anything. It was pretty tight. There were some workarounds that were put in place, using partnerships and things like that. Some states did allow that. IRS undercut a lot of that. Like there was that first attempt in the first year to make it be a charitable contribution, and the IRS put a stop to that pretty quick. But in order to get the votes, in order to pass OBBBA back in July, the SALT deduction was an increase in the SALT deduction was a non-starter, right? So they did ultimately do that. It is a 5-year increase for 2025 through 2029. The cap is moved up to $40,000, so that's for this year, right? The cap increases 1%, so it's not an inflation-based increase. It's just a 1% increase over the previous year, which gets pretty funky numbers by the time you get to 2029. But I didn't list them out here because that's more math than I felt like doing. That 40,000 limit is reduced by 30% of the excess and modified AGI over 500,000 or 250,000, married filing separately. Those thresholds also increase 1% each year. The cap is never reduced below $10,000. So regardless of how much income you have, there'll still be some state and local deduction, although probably not all that useful once you get that high. And then in 2030, it's going to go back to the $10,000 cap that was in place from 2018 through 2024. So let's see. So yeah, that's a big one, right? And that was a big deal. And it's surprising in some sense that ended up passing. And a lot of it was kind of a partisan issue at the beginning, right? Because there was a lot of higher tax states tend to be predominantly represented by Democratic representatives, but then there's Republicans representatives in there too, and they were pushing pretty hard for it. And with the pretty slim majority in the House, they eventually had to do it. So moving on, TCJA also increased the standard deduction. Part of that was because of the elimination of the personal exemption, but part of that also was an effort to, eliminate a lot of the need for people to itemize, right? So the OBBBA had a, moderate increase in the standard deduction. I have an example of it there. So for 2025, the inflation adjusted amount based on TCJA was 30,000. They increased it by 1,500. I think single is 750, and I want to say head of household is about 1,250 increase in the standard deduction. But again, that's made permanent, unlike the SALT deduction. So that's not going to sunset at the end of 2028 or 2029. That is a permanent increase. It's going to adjust for inflation, after this year. IRS did already release next year's inflation adjusted amounts. Charitable contributions. There was a 60% limit on cash contributions to public charities by individuals. That was scheduled to sunset. That is now made permanent. Newly added to this is a 0.5% floor on deductions for itemizers. That begins next year. So, that's going to function kind of the same way that the 7.5% floor on medical expenses works, right? Except it's obviously a lot smaller. Interestingly, they brought back something not from TCJA, but from some of the COVID legislation. If you remember back to 2020, 2021, I think 2020, they had put in a $300, charitable contribution limit for non-itemizers to claim without having to itemize. That came back, except they increased it. It's $1,000 now, $2,000 for married filing jointly. Again, I think if I remember right, and if that webinar attendee who found the draft 1040 is looking at it, I'd imagine it's going to be similar to the. No, it would be an above the line. So I think it was an above the line deduction in 2020 and 2021. So it'll probably be somewhere around line 9 or 10. Don't quote me on that. Yeah, so that's back from COVID. Moving along to itemized deductions, home mortgage interest deduction. TCJA cut that down, the debt amount from $100,000 or $1 million for married filing jointly, $500,000 for married filing separately, cut it down to $750 and $375. That's made permanent. Interestingly, they brought back mortgage insurance premiums. This goes way back to the 2008 housing crisis, where they first made mortgage insurance premiums deductible, and so that was like for 2 years originally, and it kept getting extended, kept getting extended. I think it finally expired in 2021, and they didn't bring it back. Well, they brought it back now. Mortgage insurance premiums are permanently treated as interest after 2025. Moving expenses, this was severely limited by TCJA. It was only for military moves. That limitation is made permanent, though it is expanded to members of the intelligence community after 2025. More itemized deductions, casualty and theft losses. Those were limited to federally declared disasters by TCJA.
It looks like Michael froze. Let me ping him real fast. Apologies. Just give us a quick second, please.
Okay, so hi everybody. My name's Ryan. I'm actually on this call as well. I'm a colleague of Michael's. I would guess that Mike is having some internet issues, and he's going to have to probably reboot his computer or potentially his router modem. I'm not quite sure. So while we try to reach out to him, at the end of this presentation, I was actually going to go over our Answer Connect tax research platform anyways. So while he's kind of getting reset up or whatever's going on over there, I'm not quite sure. I'm just going to go ahead and go over the 10 or so minutes that I had planned. I wasn't going to give great detail, but I wanted to at least give a general overview. So if you're like me, you either work or own probably a CPA firm. And when it comes to big tax law changes like this, it can be very overwhelming. I know I personally get very stuck in my ways. I get used to the tax returns, the tax codes. I don't want to change because I know how to do them. So with something as big as the one big beautiful bill, I always have tax research handy right next to me. And I typically won't go through and read every single code or item within our Answer Connect platform. But as I kind of go through and I'm not quite sure about something, that is when I will start to jump into Answer Connect as I'm preparing the returns. And what I can actually go ahead and do is I will go and share my screen just to kind of show off the platform here. And this is like my tax return Bible. Like this is what I use to give me a lot of peace of mind that I am going and preparing returns correctly, especially with some of these big changes. And I just did a quick search for, I believe, Big Beautiful Bill 1040. Very basic search. I'm not really trying to dive into anything, since we're just kind of giving this a demo. You will get an AI-generated response, but probably even more helpful than that is you will have many articles. And I know Mike went over this earlier, the no tax on tips, right? That's a big one. It's the first one that pops up when I do my generalized search. And I went ahead and opened the article just so we could kind of take a look at it. But it's going to start off with a summary, kind of explaining what has changed, how this is going to affect the tax return. It then goes into a background of this change. And one of the things that I really like about this is that everything is coded or linked back to its IRS regulations. So it's very easy if I need to get some additional context, additional detail. I can go click the link. It'll then go and bring me to the corresponding IRS codings, right? Codifications. So I can really see how it's written. But really the whole purpose of this is that we have a whole team of different staff that, they procure these articles. And as the tax law changes, they will go in and update this with the changes as necessary. And it's kind of amazing when you really think about it, when we haven't even really started next year's tax season, and we already have hundreds upon hundreds of articles on the one big beautiful bill, among updating other things as well. And, this is meant to be authoritative tax research. This is meant to be a tool that, if the IRS is, auditing a client, this is something that you can go and talk to or reference as, this is why I formed the basis that I did. And this is why, I took the deduction, or I took this credit, or I didn't take this credit. It's really a very comprehensive package. Now, if you're using a Wolters Kluwer tax software, this will integrate with the software as well. You can just go ahead, put in your login credentials and your tax returns. You can just kind of step by step see the different codes and the different articles for each line item within the return that will have a corresponding article. And when we're on a presentation that's focused on the one big beautiful bill, obviously I'm going to focus on the one big beautiful bill, which you can see all of the articles that are getting brought up here. But you can really use this for anything. Another big one would be the child care credit, right? If you're a newer tax preparer and you kind of need to run through some of these more common, I would say, credits or deductions, we're going to have that as well for you. So this is meant to be a very all-encompassing tool. It is sold separately, so you do have to purchase this, but there's a lot of different packages that'll come with this. And some of them are federal, some of them have federal and state. If you're doing international returns, there's a foreign package as well to really help you get through this. And want to take a quick moment to pause here. I'm going to go see if Mike's back, as I'm kind of going around stalling for him right now. But it looks like he's back. So I'm going to go ahead and turn this back over to him, and we will finish off what we had originally planned to go over today. So thank you so much. It was really nice to be able to kind of show off one of the tools that I use almost on a daily basis. Mike, back to you.
Thanks, Ryan. Sorry about that. I don't know what happened there, but thanks for. I can't remember where we left off, but I think it was pretty close to the end of this slide, so I'm just going to keep on going. Can everyone see the slide again? Is that we're back on? Okay. All right. So, and then now it's time for another pause for another polling question. True or false? The One Big Beautiful Bill Act permanently eliminated the cap on the state and local tax deduction. You guys, if you can answer that, give it a minute. Give about 30 more seconds. Ten more seconds. Appreciate you guys answering. 5, 4, 3, 2, 1. All right. The answer was false. It did not permanently eliminate it. It didn't even temporarily eliminate it, right? It just increased it. So very good. And again, hopefully the audio is a little bit better again. Sorry again for the technical issue on my end. I'm not sure what happened there. I think the audio issue was because I came in with a hot mic. I hope that was the issue, but hopefully you guys are hearing me now. So we're going to keep on going. This says exemptions and exclusions. It's a little bit more expansive than that, as we'll see in a minute. You know, some of this is also income as well. Just real high level stuff. You know, one of the things that TCJA did was increase the income tax rates, the brackets, and shifted them around a little bit. I think there was it was the top rate used to be 39.6 and now it's 37. Again, that was all set to expire. That was all made permanent. Real minor change. It's funny because none of the things that were done by OBBBA, there was not a single straight extension of anything that happened to TCJA. Everything had like a little bit of a tinker to it. This might be the most minor one. There was a minor change to how the inflation is adjusted for one of the brackets. Almost positive they did that for budget reasons. The estate and gift tax exemption was also increased by TCJA. It was also slightly, so that was made permanent. It was supposed to revert back to the 2017 amounts after 2025. It did increase them a little bit, but if I remember right, I think it would have been the same amount. It would have increased because of inflation anyway for 2026. So it's like not even really worth talking about. I think it's at 15 million now, or 13 and a half million, I think is the exemption. I should have written it down, but I didn't. I mentioned this earlier that they had eliminated the personal dependency exemption in TCJA. That is that's still eliminated. That is permanent. The alternative minimum tax, the exemption amounts were increased by TCJA. That was made permanent, but that when you have income over a certain threshold, the exemption amount is reduced. It's phased out. It used to be phased out, I think, for 25 cents for every dollar over the exemption amounts. After 2025, that is 50 cents for every dollar over the exemption amount. So it's an accelerated phase out of the exemption. So, not a lot you could really plan or think about. This is really more like stuff you'll react to, this year and next year. So, something to be out there to be thinking about. Oh, now to the actual exclusions. TCJA, expanded the application of the combat zone exclusion and all the various benefits that are related to people serving in combat zones, whether it's there's some pension stuff, there's a bunch of that kind of stuff. The big one is the exclusion of hazardous duty pay. Again, the amount that they expanded it to include more areas. OBBBA made that expansion permanent, and it expanded it to even more. It's a pretty long list of places now, so that's something to be aware of. Student loan debt discharge. So obviously any discharge of debt is includable in income. Student, unless it's specifically excluded. Student loan is one of those that has a specific exclusion. TCJA, I believe, made the discharge excludable if it was due to the death or disability of the student. That was going to expire at the end of 2025. That was made permanent. If you remember, in 2021, I think in the American Taxpayer Relief Act, that first that first bill that passed during the Biden administration, they had broadly expanded the discharge exclusion to discharge for any reason. That was kind of in preparation for, the complete discharge of, all student loan debt that some people were pushing for. That never happened. There's been minimal ones here and there. In that 2021 Act, it was set to expire also at the end of 2025. That was not extended. So this year is the last year that discharge for any reason will be excludable. I think I heard that the Trump administration just discharged a pretty good chunk of student loan debt due to a lawsuit, I think, by the American Teachers Union. That one still qualifies because the broad exclusion still applies through the end of this year. Next year, it would just be back to, death or disability or, bankruptcy, or if it's, for serving in, an underserved area in certain fields, I think is one of the exceptions. So just be aware of that. Moving on with a few more exclusions. We have dependent care assistance. This is, amounts received from employers for dependent care assistance. That was previously $5,000, $2,500. That is increased after 2025 to $7,500 for married filing jointly, $3,750 for married filing separately. Education assistance. This is the exclusion of if your employer pays some part of college or something like that. So that was expanded, I think, in TCJA to include employer payments of employee student loans. That was set to expire at the end of 2025. That is made permanent. Interestingly, so I looked this up, the limit on that education assistance payment has been $5,250 since 1986. It was never subject to inflation. That was just a flat amount. I think I found that it was originally $5,000 when the provision was first included in 1983. So in 86, they upped it to $5,250 and never touched it again. After next year, that amount is increased for inflation. Still not enough to pay for anything for college, but a little bit more always helps, right? So moving along, we're going to kind of talk broadly about, a lot of the rest of this falls into, things related to children, things related to childcare and education savings. So we're going to talk a little bit about that. Child tax credit was a big one. That was increased by TCJA to $2,000. And, there's the refundable part of it that is $1,400, subject to inflation. I think this year it's $1,700. OBBBA increased that child tax credit to $2,200 for 2025. There was a $500 other dependent child credit that was included in TCJA. That was set to expire at the end of 2025. That is made permanent. So that's good. Again, say it with me. Social Security number is required under OBBBA. So not a TAN, it's got to be a Social Security number for the child. So watch out for that. The adoption credit hasn't been touched in years. This did make a little bit of a change. I think it's a $17,000 credit for the adoption credit. 5,000 of that is now refundable. So just like the refundable child tax credit, if you don't have enough, income to have taxes that could eat up that the credit works for, this refundable credit can go over and above any taxable amount that you might owe. Oh, you know what? That second bullet shouldn't be there. Oops, sorry about that. That was related to the student loan thing. The child and dependent care credit. So this is for, daycare costs, things like that. I think it used to be 20% of AGI up to $75,000. OBBBA increases that to 50% for AGI, 50% of the expenses for AGIs up to $75,000. Once you get over $75,000, the credit starts to phase down and it goes back to the 20% that it was before. So moving along, and I am disconnected again. No, I'm not. Okay. It wasn't working, but now it is. So few more child-related things. One of the big things that came out of OBBBA were what were known as Trump accounts. They are literally called Trump accounts in the code. These are accounts that can be set up for children. They work kind of similar to IRAs. They have similar rules to IRAs. There's a $5,000 annual contribution for these. So it's it's with pre-tax income, so you can make those contributions. That $5,000 is adjusted for inflation after 2027. For children born in 2025 through 2028, parents can elect to have a Trump account automatically set up and seeded with $1,000 from the Treasury. It's not automatic. You have to, again, we don't have guidance on this yet, but there is something that parents will, proactively have to do in order to get that $1,000. Again, Social Security number is required for these Trump accounts to apply. Some changes to 529 plans. These have been kind of expanded over the years. TCJA expanded it out to apply to that they can be used for elementary or secondary school private education. It had a $10,000 limit on that. OBBBA increases that to $20,000 after 2025, and the list of qualified expenses that $10,000 or $20,000 can be used for is expanded to, it used to be books and room and board and tuition, stuff like that. It includes some new things like test fees and educational therapy, things like that. ABLE accounts, TCJA allowed for amounts in 529 plans to be rolled over to ABLE accounts. ABLE accounts are for, generally like disabled children to have, an account, similar to a 529, but it's, it's for, the expenses related to disabilities. That is made permanent. That was set to expire. Rollovers from 529 to ABLE accounts was set to expire like everything else at the end of 2025. So that is permanent going forward. I said that was good. Everything else was going to be covered by children and child care stuff, but I lied. There's also healthcare and some green energy stuff. We'll talk a little bit about healthcare first. Some changes to health savings accounts and what qualifies as a health savings account. You have to have a high deductible health plan in order to have a health savings account. During COVID, there were rules put in that, allowed for telehealth, which was obviously important when everything was shut down. That has been extended a couple times to, if you have a plan that has a no deductible telehealth, that is now permanent. Some bronze and catastrophic plans can be included as high deductible health plans, still qualify for a health savings account. And there were a few other changes that were included as well. Just minor things that, that are important if you need them, but definitely if you have clients who have health savings account, you might want to do a little bit of digging in on what those changes were. Premium tax credit is another thing. There were some changes. They're phasing in 2025, 2026, 2027. Again, it's mostly just, what kind of plans people are on that qualify for the premium premium tax credit. It's also, limiting the allowance for lawfully present aliens or anyone who's not eligible for Medicaid. Again, this is another one of those situations where you need a Social Security number, I believe. So watch out for that. All the news right now is about the amount of the premium tax credit. Again, like that first bill in 2021, really increased the amount. I think it doubled the amount of the premium tax credit. I think it was extended once, but that's set to expire at the end of 2025. That's a big part of what the whole shutdown is about, right? Like, the fact that those credits are expiring at the end of the year is where Democrats are kind of taking a stand on the shutdown. So you watch out for that. It might well pass that gets extended by the end of this year. I'm not sure. But I know that, from all the news I'm reading, like all those, notices are going out now, right? right? So people are starting to see the sticker shock on the loss of those credits. So just be aware of that. Again, that's not a TCJA thing. That's a American Recovery Act thing. So the last big thing on the list here is green energy. You know, and the big one there, I'm going to start with the bottom one right there. Those clean vehicle credits, those are expired. So any any electric car you buy now is not eligible for the clean vehicle credit, whether used or new, either way. But remember, that credit can still be claimed for 2025 if the vehicle was purchased before October. So the other big ones for individuals were the energy efficient home improvement credit. So that's, you know, I think that's windows and door envelopes and things like that is what that is. That credit was repealed for property placed in service after 2025. Similar credit was the residential clean energy credit. So that is for, you know, solar panels and I think, you know, wind turbines, things like that. That credit is repealed, but it's only for expenditures made after 2025. So, you know, my reading of that is if you buy something, you know, before the end of 2025 and it isn't, you know, if it's not placed in service, you know, notice that difference in language there, right? So if something is placed in service in 2026, you can still qualify for the credit. So, you know, just be aware of that. It's out there still. So, yeah, that kind of brings us to the end. I know I kind of rushed through the end there because of the technical issues. Hope everyone got something out of that. Key takeaways on this is, again, it's the varying effective dates. You know, I mean, some things are effective for 2025, some 2026, some 2027. So, you know, we have plenty of resources on CCH Answer Connect that like list out these effective dates. We have some nice tables. You know, of course, you know, all of our legislative material that we put out includes all those effective dates. So, you know, there are ways to find that in our products. You know, prepare for those changes for the 1040, right? You know, they're not huge changes, and it sounds like it's pretty limited to just a couple lines on the 1040. But there's going to be a lot more questions that you're going to have to ask clients. You're going to have to be checking in on that tip income, on that overtime income. Did you buy a car? Are you older than 65, right? So watch out for that. And of course, you know, taxpayers with children, a lot of changes there with the tax credit and education-related things. Yeah. So Ryan, hopefully, oh, yep, there is one more poll question. Thank you for that. True or false, electric vehicles are eligible for a clean vehicle credit if they are purchased before the end of the year. So if you want to run through that, I know we're running up towards the end of time, so apologies for that. But if you want to go ahead and answer that. I don't think I've seen start dates for filing season yet. The last I heard was that the commissioner who was recently fired was pushing for a delayed start to filing season, but I don't think they actually went through with that. But we'll see what happens with the shutdown, right? You know, if this drags out, you know, for months and months, I would imagine there would be a delayed start date. I believe there was a delayed start date in 2019, which was the year of the last big shutdown. So don't quote me on that. I don't remember exactly. So I'll give you a couple more minutes on the poll question. Thanks for hanging in there. I know we're kind of right at the end of the hour here. Ryan, hopefully you had enough time to do your end of things.
Yes, well, you were rebooting. I was able to go through Answer Connect and give a quick poll of it.
All right, so we'll close this polling question. Ooh, it was a trick question. They can't be purchased before the end of the year. They have to be purchased before the end of September in order for it to stop. So in order to claim the credit, but you still can claim the credit if it was before the end of September. So we already saw the demo, so I think that's it. There's this one last polling question if you want to learn more about TaxWise Online or CCH Answer Connect. But thank you all. appreciate your time today. And again, apologies for the technical issues, but thanks for hanging in there.
Thank you, Mike. And if you are interested in either one of these products, our tax research platform, TaxWise or Answer Connect, go ahead, give us a yes. We'll have someone reach out to you. If you're not interested, that's perfectly okay too. We like to be a wealth of knowledge for the industry as a whole. And in just a second, once people are done answering this, if you are interested in TaxWise, I'm going to go ahead and put a promo code on the screen. Where if you do an online purchase, we are currently offering 25% off, which is about the biggest discount I've ever seen. And I've been here for about 4 years. So what I'm going to go ahead and do, I'm going to give everyone just a little bit more time to answer this one. Looks like we have a majority here. Okay, so what I'm going to go ahead and do is I'm just going to bump it one slide back. Like I said, if you are interested, we are offering the 25% promo. The promo is going to be on that third bullet point, USZP 25 N2N TW Web. And you will just, if you put this in your cart, you go to actually make the payment. It'll ask if you have any promo codes, either copy and paste this or type it in as you see it right here. Get you a 25% discount. I've also included a link within the first bullet point just to get you there. But honestly, you can just Google buy TaxWise and it'll be the first link that pops up as well. It's pretty easy to find. You don't have to use this link in order to get the discount. The main thing is just input this promo code. So, I'm going to leave this on the screen for maybe a minute. I know most people have probably left by now. Want to thank everybody for, spending some time with us and taking some time out of their day in order to learn about OBBBA. It was very beneficial to me personally, I can tell you that. A lot of good things in there. And be on the lookout for more presentations that we do. We typically do 1 or 2 of these, whether it's OBBBA, whether it's different sections of the tax return. There's quite a bit of different places that we will go over. So be on the lookout for more meetings and look forward to working with some of y'all in the future, or just seeing y'all in these meetings and kind of talking about some of the changes that are happening to the tax law. Thank you so much, and everybody enjoy the rest of your day.